Fed minutes show a divide over the September rate cut. Here to discuss that is Ann Bartels of Sanctuary Wealth, and I'm Lisa Bernhard with Reuters. Ann, we know that ultimately there was only one Fed governor, Michelle Bowman, who voted against that 50 basis point rate cut back in September. But what did you take away from the Fed minutes that came out today?
I don't think they were really that surprising. There was a little bit of a debate going on whether or not they should cut 50 basis points or 25 basis points. And of course, they decided to do 50 basis points. But originally going into that meeting, the market was really set on 25 basis points. It was only a few days prior to the FOMC meeting that it got leaked to the press that they were looking at a 50 basis point cut. They were trying to set the market up for a rate cut. What that tells me is that Chair Jerome Powell was the one that wanted that rate cut, and he needed to get consensus on the FOMC committee, and he did. He only had one dissent.
Chair Powell also talks a lot about getting to a neutral rate. Explain exactly what that means, because that's not 0%, right?
That absolutely is not zero. And it's really, it's not a hard and fast number. But let me kind of explain around neutral. So you have two other options. The Fed can have easy monetary policy, or they can have tight monetary or restrictive policy. For easy policy, you'd be below the neutral rate. You think your rate is much lower to stimulate the economy. When you have restrictive, you're going to have a higher rate and you're trying to slow your economy down. Neutral is actually the balanced rate, where you don't feel that you're restrictive and you don't think you're easy. It's almost like Goldilocks, that you have it's just perfect. It's just right for the economy to grow, but not constraining the economy. That's also known as R star. If you ever read about R star, that really is what they call the neutral rate. And what some experts believe, because we really don't know what the R star is, they think it's somewhere around 3%.
We had a really strong jobs report, the last jobs report that was out. And I have to address now, obviously, these devastating hurricanes that are putting people out of work. What do you think is the potential for the disruption in the jobs reports to come?
It's certainly very possible. And you mentioned the last jobs report. That would be the September jobs report. To be really honest, it was shockingly strong. The Fed is easing not because of inflation. They feel inflation is coming down. They're easing because they feel that the employment picture is slowing, and it has been in previous data. So to have this really strong jobs report in September was shocking. But we do have one more jobs report before they decide what they're going to do with rates in November. And maybe that report will show an easing up because of the events, as you mentioned, the horrific events with the hurricanes that Florida has been having.
Switching gears here a bit, this Friday kicks off earnings season with the big banks. What will you be looking for in particular this earnings season?
Well, when people are looking at bank earnings, they tend to be hyper-focused on what they call net interest margins, or it's called NIM. And that's how a bank earns money. So they're going to be very focused on how is net interest margin growing and what's the anticipation of that as the Fed is cutting rates, because many expect that NIM will actually fall, meaning profits will be lower as the Fed cuts rates. Now, it doesn't mean it has to be that way, but that's the concern, and that's what many analysts will be very focused on. I'm not so much focused on banks as I am in technology. So why do I say that? When we look at where the earnings growth rate has been in this market and where it continues to be forecasted to have the biggest strength is actually in tech and tech related. I think that's going to be much more important to the market than what the banks actually wind up reporting.
What about all this talk of a rotation finally into smaller caps and a broadening of market gains?
I'm not a fan of small caps. Now, when markets go up, they always say a rising tide lifts all boats. We are seeing small caps go up, but they're not outperforming the S&P 500. So they are not what I call leadership in the market. I still think large cap, particularly mega cap, are the leadership within this marketplace. We also have to remember the reason why stock prices go up are based on earnings and anticipated earnings. Almost 50% of the stocks in small cap don't have earnings. So would you rather own a company with earnings or a company without earnings? I'm pretty sure you want those earnings. And if you want those earnings, stay with the S&P 500 or the NASDAQ.